Welcome to Wealth. I'm Alexandra Canal, filling in for Brad Smith, and this is Yahoo Finance's guide to building your financial footprint. Our community of experts will give you the resources, tools, tips, and tricks you need to grow your money. On today's show, we're closing out the month of September and the third quarter of the year. We'll break down how you should be positioning your portfolio heading into year end. And Homeowners Insurance 101. We'll talk about what the average policy does and does not cover and get you tips from an insurance agent. Plus, global entry fees are going up for the first time ever on October 1st. We'll tell you how to lock in today's price before the deadline. But first, it's the final trading day of September and of the third quarter. September is usually known as a weak month for the stock market, so let's see how your portfolio may have performed in the last month. So we take a look at the major averages here. We'll see the S&P 500 over the past month is up about 1.5%. Similar story with the Dow Jones, and then the NASDAQ up just a little over 2%. So we're seeing stocks hover at these record highs. In fact, so far this year, it is the best year for equities since 1997. So not too shabby for a month that is typically sluggish. And what we've been seeing is this rotation out of tech and AI into more defensive areas of the market and into more interest rate sensitive areas of the market as the Federal Reserve begins its easing cycle. So we're seeing for the month, we have things like consumer discretionary, communication services, materials leading the way higher here. I also want to take a look at what we've seen overall in the third quarter. Energy, the biggest laggard. You're seeing technology here. Technology has really led markets higher in the first half of the year, not necessarily the story in the second half. The bottom three of the biggest laggards of the quarter, and then utilities, number one, real estate, again, interest rate sensitive area, industrials, materials, and financials rounding out the top five there. Now, I want to go back to small caps as we've been talking about interest rate sensitive areas. Small caps, typically we've seen some seasonality there, but over the past month, the Russell 2000 is up about 1% there, but over the past 3 months for the quarter, we're seeing a 9% gain for the Russell. And then finally, I want to do a quick check of Bitcoin. Bitcoin has been on a 3-week rally here. So if you take a look at a 1-month chart, you're seeing this price is up about 8%. We're currently hovering below $64,000 a coin, but the Bitcoin bulls, they're targeting 75,000. So we'll see where things go through the end of the year. But for more on how to position your portfolio for that time, we have Jay Woods, Freedom Capital Markets Chief Global Strategist. So Jay, thank you so much for joining us. As we just laid out, strong third quarter for stocks. How much upside do you think there is through the end of the year, especially with the start of the Fed's easing cycle?
Yeah, I think that Fed easing cycle will be the story once we get through the election. We're going to get some crazy headlines and some jitters as we get to that early November election. And then once we get through that, as we saw in 2016 and 2020, I think we're off to the races. The setups are there. You just went through the quarter leaders and losers. What was the second biggest loser? Technology. I think technology is poised to come back as we continue to rotate from sector to sector and take us higher in just the overall market. You look at the 3 biggest stocks in the technology sector: Nvidia, 15% off its highs; Apple, about 5% off its highs; Microsoft, 8% off its highs. I think we're going to get a nice tailwind, and guess what? We saw the story exactly happen last year. So I think the setups are there. With the Fed easing cycle, it takes a little while to get us going, and come November, December, this is the strongest quarter of the year. On average, we're up 3.7%. Now, when we hit a September high like we did this year, 19 out of 21 times. This is a Ryan Dietrich, give him props quote. We've gone higher 19 out of 21 times when we made a new high in September, and the average gain is 5%. In election years, it's 6%. So I think the setups are there, and the rotational trade will continue, and we'll rotate back to technology.
Yeah, and to that point, the fact that we've been at these record highs without the help of NVIDIA, that has been something that we've been keeping an eye on closely. But this Friday is the jobs report, right? Yep. Next big catalyst for equities. Let's say we see the unemployment rate edged slightly higher. How concerning is that for you? And do you expect an overreaction on the part of the market, no matter what the economic data tells us?
Well, I think we'll get an overreaction.
Yeah.
The market's been jittery. It's been the CPI, and now with the dual mandate and the focus being on jobs, I think that unemployment number really gets scrutinized more than ever before. We're looking for 4.2%. I expect it to be probably right there in line. If it isn't, if it's higher than that, then they're going to talk about rate cuts and maybe we need more, and how will that upset the inflationary side of their dual mandate. So we're going to be watching that one closely, coming right out of the gates for October. That's the one thing traders are focused on the most.
And you alluded to how markets have really been overreacting to every one piece of data there. So as an investor, how do you play some of that volatility? You mentioned the election cycle earlier, likely to be some volatility there. Should you be preparing your portfolio in any way?
No, I think investors have to kind of block out some of these headlines, especially come election rhetoric. We're getting a lot of gloom and doom, a lot of negative things, but the economy has been hitting. Earnings growth has been stable. Earnings season kicks off a week from Friday with JP Morgan. I know we have Nike this week. We're going to watch that closely. But overall, the trends continue to be positive economically. So these headlines may cause jitters. Yes, there's geopolitical risk. We're going to always have that in the backdrop. But I think the way we're set up with this rotational trade, with I think 7 new sectors breaking out. You mentioned materials just broke out. Industrials looking fantastic. Discretionary, phenomenal. Communications, here we go. So to me, the setups are there, and there's a lot of money on the sidelines, people missing out. So once we get through that election, that FOMO trade may really ignite a rally. And, I'm talking 5%. That gets us over 6,000. It's going to sound like a headline. Wow, guy predicts 6,000 in the S&P 500. But when you look at the math behind it, it's kind of logical given the tailwinds we have behind us.
Do you think there are any sectors that are poised to really benefit the most from that FOMO trade?
Well, technology without a doubt, because people are going to be like, wait a second, we just had a bit of a sell-off there, not at 52-week highs, we'll get in there. And I think utilities continue, the leading sector of the year, continue to be the one trade people are looking at. They're not our grandparents' utilities anymore. These are not dividend-safe plays. There's technology behind it. So that AI story, you look at cybersecurity stocks, the CIBR and the Hack ETF, both breaking out to new highs. And then IGV, which is the software ETF, not enough love, try saying that 5 times fast, for that sector, also breaking out. So the setups are there, but utilities is one sector. It hasn't led other than the year 2014. It looks like it could be the leading sector this year. And if you look at that on a weekly chart as a technician, I know Jared is going to love this in the back over here, that just broke out of a very nice base. I think utilities are a sector we're going to focus a lot on come 2025.
Right, and that's something in the beginning of the year I wouldn't have thought utilities would be leading the way higher.
Not in a million years.
Just goes to show you cannot predict this market. But Jay Woods, Freedom Capital Markets Chief Global Strategist, thank you so much for joining us today. Yep. Chinese stocks are soaring today, building on last week's rally following the announcement of Beijing's economic stimulus plan. So is now the time to buy? Yahoo Finance's Josh Lipton joins me now to explain.
That's right, Allie. So many investors, remember, have thought of Chinese equities as almost uninvestable in recent years, but not anymore. They have piled in to Chinese stock. It is a big change in sentiment, and it's thanks to the Chinese government, which announced long-awaited stimulus measures aimed at boosting their struggling economy, and that got investors excited. Check out the FXI, the ETF that tracks China large-cap companies. It has moved sharply higher, up nearly 20% in just the past week. Its best week ever, going all the way back to the start of that ETF in 2004. So looking ahead, is this a good time to buy Chinese equities? Well, some very well-known investors are pounding the table that indeed it is. For example, billionaire investor David Tepper told reporters he is buying everything related to China. I thought that what the Fed did last week would lead to China easing, and I didn't know that they were going to bring out the big guns like they did, Tepper telling press last week, adding, we got a little bit longer, more Chinese stocks. And here on Yahoo Finance, we spoke with Anthony Sassine of Crane Shares, who echoed that same optimism, arguing that many Chinese stocks have already been plenty beaten down. In other words, they have already priced in a lot of bad news, in his opinion, and now do look attractively valued, primed to benefit as this new stimulus does kick in. However, there is another side of this trade too, of course. Strategists who came on Yahoo Finance and urged caution, telling us that the jury, in fact, is still out.
So only time will tell, but repeated attempts in recent years have not led to lasting gains. Now, of course, a potential 20% market rally could boost China's consumer sentiment in the near term, but that might be offset by the continued weight of the property market on confidence.
So Klein Top's bottom line there, yes, these recent moves by the Chinese government do represent a positive step, but it is unclear right now, he would argue, how long lasting an impact that's really going to have on the Chinese economy and markets, Allie.
All right, Josh, thank you so much. Certainly something to keep in mind as we move forward. Appreciate it. Coming up, homes across the southeastern United States have been damaged by Hurricane Helene. I'll speak to an insurance expert about the coverage you can expect in case of an emergency like this. That's next on Wealth. The Southeast grappling with devastation after Hurricane Helene ravaged the region over the weekend. There have been more than 90 storm-related deaths reported across 6 states. Hundreds of people remain unaccounted for, and millions are without power. Moody's Analytics is estimating between $15 and $26 billion in property damage alone. One way for homeowners to protect themselves against some of that damage is through homeowners insurance. Here with more is Jason Rodriguez. Jason is an agent at Trusted Choice and is the principal owner of Prominent Insurance. Jason, let's start at a high level here. What does a storm event like this mean for homeowners?
It could be devastating, loss of life. We want to send condolences for those that lost their life in this storm as well. High premiums, insurance carriers leaving that region because of current, situations with hurricanes and all types of catastrophic events.
Jason, you pointed out to us that standard insurance does not cover flooding. So if you're someone who has been impacted by this hurricane and that insurance that they had did not cover flooding, what's the next step there?
The next step, if the government doesn't come in, FEMA doesn't come in and, rectify the homeowners, make them whole again, then unfortunately they have to recover that loss on their own. They self-insure in that particular flood.
So what does standard insurance typically include? And are there other catastrophes or weather-related events outside of flooding that's left out of that standard package?
So flooding is a big thing in flood zone areas, but the standard homeowner package has the coverages that will cover for, the catastrophes outside of flood, wind, hail, but the deductibles in certain regions can be higher than most because of the current situation of the constant flow of these hurricanes and natural disasters as well.
So can you talk a little bit more about those deductibles and how homeowners can really look to that?
So yeah, in certain areas to lower, to get lower premiums, you want to fortify your home, especially in Florida and places where the hurricane is actually hitting. You want to fortify your home to get discounts from your insurance carrier. You can raise your deductibles as well, which will lower your premiums. And you also want to be able to bundle so you can see if you can save additional discounts with your existing homeowner carrier.
And we talk about premiums a lot too, and you said that in certain areas like Florida, for example, where there are higher risks of hurricanes, your premiums can actually be raised. How often does that happen? And as a homeowner, do you have any wiggle room there or negotiating power?
Yeah, you do, especially you would like the deductibles, especially the wind and hail deductibles in those areas. So there's some wind and hail deductibles that can go up to like 15, and I've seen some as much as like in the thousands, high thousands for wind deductibles, which will lower their insurance premiums. So that's the only negotiating power that you have. And also, like I said, fortifying fortifying your roof, fortifying the windows, having a certain standard to cover against these risks as well.
And there are a lot of people who unfortunately got displaced from their homes after a hurricane like this. Does insurance protect against those associated costs?
Yes. So in event of something was to happen of a covered loss, you do have where they relocate you, they put you up while the damage is being repaired. So you do have that in the standard homeowners policy already baked into the policy in your premium. So that's a coverage that is very important as well. It's additional living benefits.
And can you give us some tips for people who might be filing an insurance claim after this storm damage?
So, you always want to document thoroughly, take videos of all your possessions. You want to contact your insurer, promptly as well. You want to contact and, make sure you have a trusted choice insurance agent so you know the benefits that your current policy holds. And understanding your policy is the key, especially in areas where there's high natural disasters that come through. You definitely want to understand your policy.
Jason Rodriguez, trusted choice agent and principal owner of Prominent Insurance. Thank you so much.
Thank you for having me. I appreciate you very much and have a beautiful day.
You too. Keeping up with the housing market, the use of home equity lines of credit or HELOCs is on the rise. Cash-strapped Americans are using this type of loan to help pay down their debts. Here with more is Yahoo Finance senior reporter Claire Boston. Now, Claire, before we get into what is really happening here, can you first explain what a HELOC is and why more folks are turning to that?
Right, so a HELOC stands for a home equity line of credit, and it is sort of like a credit card based on your home. It's backed by your home equity, and it is a tool that consumers can use to do things like have renovations, consolidate their debt, and it is in addition to your mortgage. So it is a second credit line. It typically has a higher interest rate, but it's an appealing option right now for a lot of people because they have mortgages that are maybe 3%. They don't want to refinance their mortgage, but this is a separate credit line that can still allow them to tap equity in their home.
Are there any risks of using a HELOC? Because as you said, it's sort of second to a mortgage, so more debt, essentially.
Right, it is more debt, and ultimately this is debt secured by your home. So you have to make sure you're going to be able to make those payments. In a worst case scenario, the bank could end up owning your home.
Mm-hmm. With the Fed lowering interest rates, does that have anything to do with why HELOCs could be on the rise, or do you anticipate more Americans to go towards that option?
Right, so HELOCs are based on the prime rate. So when the Fed drops interest rates, HELOC rates drop too. They are higher than a conventional mortgage. Around average right now is 9% or so. But if the Fed continues to cut and we see mortgage rates and prime go down, we would also expect HELOC rates to get lower.
Okay, so something to watch as the Fed continues its easing cycle. But Claire Boston, thank you so much. Appreciate it. Financial planning can help you achieve long-term goals, and my next guest has ways to help you win no matter what. Joining me now is Providence Financial Insurance Services President Anthony Siccaro. Now, Anthony, there are a lot of uncertainties right now, but for someone who is actively saving, what should be the first step? What should people be paying attention to?
Well, I think the first step is to develop some kind of a plan. If you read my book, if you hear my podcast or listen to my radio show, the first step is almost always develop a plan. And that plan is going to dictate where you're going to go. That plan is going to be your guiding post, your true north for whatever phase of life you're in. When you have a plan, I think there's going to be two benefits of that. Number one is you're certainly going to know where you're going. If you don't have a target, then how do you know if you're headed in the right direction? So knowing where you're going. But I think the more valuable part of a plan that's often underlooked and underemphasized is the simple fact that it helps you not panic when things don't go your way. Part of your plan has to consider that not everything is going to go your way all the time. We know that. You have to plan for that, and no good decisions are ever made when you panic. So if you have a plan, it's going to help you not panic. And I think that's really the first step, whatever phase of life you're in. Have a plan so you know what direction you're going and you don't panic when the storm hits.
Mm-hmm. Now, should you adjust those plans if you maybe get a sign that a storm could be coming, right? I mean, we often have a lot of these economic indicators that we discuss on this show. So if there's an indicator that points to worsening financial conditions, should you adjust the plan that you have in place?
Oh, yeah, absolutely. And not only should you adjust the plan, you're going to be forced to adjust the plan along the way because we don't know what's going to happen. Imagine wanting to drive from California to Florida. You're going to map it out. You're going to punch it into Google Maps. You're going to know what direction you're going to go. But then with weather conditions, with road closures, with accidents and so on, you're going to need to adjust that route as you go. And it's no different, whatever phase of life you're in. You must adjust your plan as news comes out and as economic conditions change.
And focusing on the stock market and investments, how do you make sure that your portfolio is diversified enough to really account for all those possible scenarios?
So I think it's important to diversify among asset classes instead of just in one asset class. It's very common for someone to come in off of my, however they come in, however they meet us and sit down with me, and for them to believe that they're diversified. And to them, what that means is that they have a bunch of stocks or they have a bunch of mutual funds. Well, the reality is they're diversified within one asset class, but it's really important to be diversified among asset classes, not just stocks, but add some bonds or fixed income. Additionally, we can be talking about real estate, add some real estate in there. Additionally, we could be talking about within each class, you can be diversified as well, too. Within stocks, there's sub-diversifications. There could be the blue chip stocks. There could be small caps, mid cap, large caps. Within bonds, you could have junk bonds. So diversification, not only within an asset class, but among asset classes is also very key.
And what's the biggest financial planning mistake that you often see people make?
Yeah, I'm going to say by far the biggest mistake that I see people make is not being invested properly for the phase of life that they're in. This generally affects the older generation, people that are retired, more than the younger generation. People that are younger in the accumulation phase of life are often dollar cost averaging in mutual funds and stocks, and that's what they should be doing. And if they don't make a lot of changes, but they've got 10 or 20 or 30 years ahead of them, that works out to be okay. But if you're 60, 65 years old, you're on the brink of retirement, the biggest mistake that I see those individuals make is they stay invested the way that they've always been invested. And even though their life is about to make a paradigm shift, they have not made any type of shift with their investments. And you must be invested properly for the phase of life you're in. If you're going to be retiring and you're going to need income off your portfolio, that's going to be a completely different strategy than when you're heading to retirement and you're putting money in. In the accumulation phase, you're saving, you're adding. In the distribution phase, the retirement phase, it's about protecting and withdrawing. Two different strategies, but most people don't ever make that shift, even though their life has.
So protecting, withdrawing, what other things can folks do if they are preparing to retire to make sure that they're not making those mistakes?
Yeah, so there's a few other things in addition to the finances. It goes back to developing a plan, making sure you know what your income and expenses are. If you don't know what your income and expenses are, then the fact is that you're simply not going to be able to develop a plan. It all is going to start with that. You want to also make sure that when it comes to your income, how do you maximize your income? If you have Social Security, what's the best way to take Social Security? It's very complicated. Sometimes it takes software to figure out the best way to take Social Security. If you have a pension, how are you going to take your pension? You're going to take it as a single survivor annuity, as a joint survivor annuity. You have to have all that ahead of time. You also have to plan for inflation. You also have to plan for the expenses that you don't have now. If you're going to retire and you're going to travel, that's going to be added expense. So it really goes back to developing a plan that's going to help guide you going forward, whatever stage of life you're in, but more important, I would say, in retirement.
Important advice. Anthony Soccaro, thank you so much for joining us.
Thank you.
Coming up, is the American dream still attainable for some? I'll speak to the editor-in-chief of Investopedia about how realistic the dream is for most Americans. That's next on Wealth.
Are you a passionate investing bull? Maybe you love scooping up shares of NVIDIA on every single dip because, well, AI is changing the game. Fascinated by PE ratios and how the presidential election outcome may impact them? Then come one and come all to the 2024 Invest Conference. Huge power players all under one roof. Thought-provoking discussions on November 12th at Second in New York City. We can't wait to welcome you to Invest 2024 live at Yahoo Finance all day.
The American dream is hard to describe. For some, it's all about financial success and owning a home. For others, it represents freedom, educational opportunities, or the pursuit of happiness. However you define it, one thing is clear. Achieving the American dream comes with a hefty price tag. A new report from Investopedia projects the American dream now costs a staggering $4.4 million. Is this even attainable? And how can we reach it? Here to weigh in is Caleb Silver, Investopedia editor-in-chief. Caleb, 4.4 million. How did you come up with this number, and how does it compare to last year? And that was the first year of the report.
Yeah, 4.4 million sounds like a lot because it is a lot, but we're talking about a lifetime of earnings, right? 25 to 65. How much money you would need to have the things that we want, not necessarily need. So we were looking at what people were actually searching for on our site. We always do this. And last year, the American dream kept popping up. And it wasn't like, what is it? But could I ever attain it? And given the price of everything, especially housing, especially education, and rising costs for healthcare, more and more people felt disassociated with it. So we put this number on it. But these are the wants. We're talking about having enough for retirement, right? Having enough to pay for a wedding, raising a couple kids, sending them to a public university. So 4.4 million over that lifetime. Yes, a big number. Last year, a little bit closer to 3.5 million. But we looked at what people actually want, not the essentials like housing, right? You got to feed yourself and you need healthcare, but all these other things, having a pet, paying for a funeral, buying a few new cars over the course of a lifetime, this adds up.
So how are we seeing the high cost of this American dream change how people are actively living their lives? For example, renting versus buying a home, even the number of kids you have. How do you see these shifts sort of play out?
Right, and the funny thing is, this number is what we thought for a household, right? 3.3 people, but people make choices about their lives. Some people don't want kids, some people don't want pets, some people don't have a used car. But if you think about the things that we might want, reasonable expectations, that's where you come up with this number. So people are coming up with creative ways of putting this together. But one thing is absolutely certain. If you work for a lifetime, 40 years or so, at the median income, you're going to wind up with something like $2.8–3 million. You're going to have a gap between how much you make and how much you might need if you need money for retirement. How do you fill that gap? You have to fill that gap by investing, by owning assets. You have to have your money working for you while you're over here working and getting paid. Your money's got to be working in the background.
And how does this change depending on demographics when we talk about the racial wealth gap or even the gender pay gap as well?
Great question, because this is a big number for anybody. But when you look at the median income, that could apply to anybody. But we know people make different choices depending on the communities that they live in. People make different life choices. Again, some people might not want to have kids. Some people might have a dual income family. Having a dual income family is a great way to achieving this number and beyond. If you have two people working, even at the median income, you'll wind up with something like $5+ million over that course of a lifetime. You might be in a pretty good position to make these choices that you might want to have. Taking an annual vacation, right? Or having a pet, having a few pets over the course of a lifetime, sending kids to college. But if you look at what different generations are doing and different racial groups, they're making different choices so that they can live their American dream, whatever that is.
You mentioned investing in the stock market. Are there other things that people can do to try and reach that number and make it a more attainable goal?
Yeah, and the thing is, it's your number, so you have to come up with whatever your number is. And the most important thing we talk about, especially in financial planning, is what does it cost to be you, and what does it cost to be the you want to be? Once you get to that number, work your way backwards. So if you work your way backwards, maybe that number for you is $2 million. Maybe it's $6 million. It depends on what you want ultimately. So working your way backwards from that and saying, if I make X amount and I get a raise of 3% a year for this long, but I invest and my money is compounding, that is a way for me to achieve these goals. And that's what planning is all about. But also you have to have asset ownership in this country. That's just the way it is in this American form of capitalism that we've come up with. You have to be invested and you have to have asset ownership, whether that's a home or other assets that are going to appreciate over time. You have to be in there, and you have to be in there early. The earlier you start, the better off you are. That number doesn't seem so intimidating if you start investing and saving when you're 25 versus 45.
And is there a fiscal responsibility to try and drive down the high cost of living? It was just something, as I was reading this report, especially with the election upcoming, how something like this could really play into the politics of it all.
We're already hearing it all across the campaign trail. You either hear from the Trump administration, from the Trump campaign, I should say, that the American dream is dead, it's not attainable, or you hear from the Harris campaign that we're going to try to restore it. We're going to do whatever we can, and that means potential tax breaks for home ownership, new home owners, trying to get people into the housing market, because we know that is a way to see your assets appreciate over time. But ultimately, you're the CEO of your own life. Your dream is your dream. You have to come up with that numbers. I wouldn't wait around for the government to solve that problem, because ultimately it's about you and how much you can invest over time and how much it costs to be the you want to be.
All right, love it. The American dream, hopefully alive and well for most Americans, but certainly have to take a lot of steps to get there.
That's right. It's our dream.
It's our dream. It's our dream. Thank you so much, Caleb Silver, Investopedia editor-in-chief. Appreciate it. Coming up, Fed rate cuts could change how you spend this holiday season. I'll speak to the CEO of Split It about that next on Wealth. The Federal Reserve made a big rate cut 2 weeks ago, and it's already trickling down to lower borrowing costs for consumers. American Express and U.S. Bank already lowered the APRs on several credit cards on their website by 0.5 percentage points, according to LendingTree. And with holiday shopping season just around the corner, this could have an impact on spending. Joining me now is Nandan Sheth. He is the CEO of Split It, a platform that allows consumers to split up a purchase on a credit card onto monthly installment payments. Nandan, to start, what are your expectations for holiday spending, and how big of an impact could we see from these rate cuts, especially since monetary policy typically operates on a bit of a lagged effect on the economy?
Yeah, I think, firstly, thank you for having me. I think the impact for consumers is going to be hard to predict. As you know, the rate cuts will flow through the system, but it will take a little bit of time. So I think really the emotion around greater confidence with a rate cut and additional rate cuts in the future, complemented by a strong stock market, I think will drive additional sales during the holiday season. And I think the dark horse is going to be small businesses, which behave in many cases like consumers. Not only are they going to be more confident, but they can actually see the impact of a 0.5% cut. And I think will invest in their businesses more greatly starting off with the holiday season.
And we have been reporting on a more squeezed consumer, more Americans carrying more debt. Given that, how should people assess buy now, pay later options while also making sure that they're adequately managing that debt?
Yeah, that's a great point. As you know, credit card debt has hit $1.14 trillion, highest in history. And number two, 20% of the cards are maxed out. So my answer would be very, very carefully. So what I think will happen is with the lower rates in general, merchants will have more 0% offers. And especially merchants that support credit card installments, where you don't have to originate a new loan. So look for offers that are 0%. They're primarily going to come from high margin merchants, travel, luxury, home improvement, home goods, and then ensure that you don't get into the trap of fees if you're delayed in making those purchases. But I think there's a lot of opportunity out there if you look for those 0% offers.
Mm-hmm. And there has been more of a trend of paying off some of those buy now, pay later installments with credit cards. And that's the crux of Split It's business model. But what are the dangers of that, since you're essentially paying off debt with more debt, correct?
Yeah, so our model is not paying credit with credit, which is a big no-no. Our model is you already have credit from your banks. We unlock that for 0% installments. So we're actually not credit on credit, like some of the other BNPLs operate a different model where they originate a brand new loan and then consumers try to pay that with their credit card, which I think is super bad. And I think you'll see many more banks, including Chase, that have announced that they're going to stop that practice.
So how do you expect retailers to really respond to this shift, or really how should they respond given that we've seen debt levels increase?
Yeah, that's a great question. So if you look at some of the studies that are out there, including Bain has a consumer shopping study for the holidays, the predictions are that online commerce during the holiday season is going to increase year over year by between 8 and 10%. Which is a fairly decent increase. Now, if you're a retailer, also know that 50% of the purchases for that online or e-commerce channel are made using a mobile phone. So target your offers and ensure that your e-commerce channel has those offers that are very easy to consume. And the less friction that you have for those consumers to benefit from the 0% financing offers, the better. So I think retailers that focus on e-commerce, that have offers that are well organized and available for the mobile form factor, I think will do very well.
All things to keep in mind as we quickly, I should say, enter the holiday shopping season. Nandan Sheth, CEO of Split It, thank you so much for your time today.
Thank you for having me.
Turning now to a subject top of mind for many. Today is the final day of the Biden administration's one-year grace period for missed student loan payments. Here to help with what student loan borrowers need to know going forward is student loan expert Mark Kantrowitz. Mark is the author of the book, How to Appeal for More College Financial Aid. So Mark, what does the end of this pandemic-era grace period ultimately mean for borrowers?
Well, borrowers, about 6.7 million borrowers who took advantage of the 12-month on-ramp will now have to start making payments on their loans. There are a few ways they could continue implementing a payment pause, but interest accrues and those options are limited.
And how many student loan borrowers took advantage of this on-ramp period, and what does that potentially mean now that it's over?
So a total of 6.7 million borrowers took advantage of it. And the on-ramp was essentially a set of retroactive 90-day forbearances. So every 90 days, they would see if someone hadn't made a payment. If so, they put them into a forbearance where interest would accrue, but no payments were due. Now that they have, they're going to have to start making payments. There are options like standard 10-year repayment, extended repayment, and graduated repayment, but the income-driven repayment plans are tied up in a lawsuit and may not be available. So they're going to have to start making payments, typically a few $100s a month for the average student loan.
You talked about some of those repayment options, but is there an option to just not pay at this point to halt some of those repayments? And if so, is that something you would even recommend?
So there are deferments and forbearances, which are available up to a maximum of 3 years in one-year increments. Interest may continue to accrue during a deferment or forbearance. So this is just digging yourself into a deeper hole. If you can afford to make the payments, you should, because eventually you'll need to pay off the debt. And the longer you delay it, the more it's going to cost you.
And, there have been a lot of stops and starts with Biden's student loan forgiveness plan. What's the current state of play, and how do you see it all playing out as we near closer to that November election?
So there are two main sets of pending lawsuits. One is against the SAVE repayment plan, which is an income-driven repayment plan that replaced the REPAY plan. The other is Plan B for broad student loan forgiveness. Even though the final rule hasn't yet been published, a stay was issued to prevent the Biden administration from forgiving the loans under that broad student loan forgiveness, because there was some word that maybe they were going to be very aggressive in forgiving the loans immediately upon publication of the final rule. And both of these cases are still going on.
So both of them still going on, that TBD factor. What have we heard so far from the Democratic presidential candidate Kamala Harris about student loan forgiveness? And do you expect to hear more from her as we near closer to November?
Well, she supports student loan forgiveness and making college more affordable. So it is a factor that differentiates between the two political candidates. Generally speaking, Republicans oppose loan forgiveness, whereas Democrats support loan forgiveness. And if you look at Project 2025, it proposes getting rid of the public service loan forgiveness plan that has existed for many years.
And do you expect Donald Trump to speak more on student loan forgiveness, or is that an area that he's sort of avoided?
Well, so far he hasn't spoken about it very much at all. His focus has been more on the economy and inflation and the border wall, and less on social programs like student loan forgiveness and Social Security and Medicaid.
Well, a lot of Americans will be looking to that November election, especially when it comes to the state of play for student loans. Mark Kantrowitz, student loan expert and author of How to Appeal for More College Financial Aid. Thank you so much for joining us today.
Thank you.
Coming up, global entry is about to get more expensive. We break down how you can save some cash. That's up next. For the first time ever, global entry fees are rising. The cost will now be $120 for 5 years. That's an increase of $20 from the prior price. You have less than 24 hours to lock in the lower rate for the expedited security program. If you already have a membership, you might want to look at when it's going to expire. You can renew up to a year in advance and lock in that lower rate. But if you have kids, it might be best if you apply after October 1st. Children under the age of 18 will no longer have to pay the membership fee as long as their legal guardian is a member. If you want to apply, you have to create your own Trusted Traveler Program account, also known as a TTP. Then complete the application. You'll have to pay the non-refundable fee at this point. The U.S. Customs and Border Protection will then conduct a review, and if your application is conditionally approved, you'll have to schedule an interview at a global entry enrollment center. You'll be asked to bring your passport and another form of identification, usually a driver's license, to the interview, and expect to be asked about your travel history. Then you're done. Renewals have a similar process, but you might not be required to do another interview. Only U.S. citizens, lawful permanent residents, and citizens of certain countries are eligible for Trusted Traveler programs. Well, speaking of travel, if summer trip prices were too expensive for you this year, this fall season could be a great time for traveling at a discount. Our own Carrie Hannon joins us now with more. So, Carrie, is now the time that I should be looking into taking that trip?
Good morning, Allie. Yes. It is a good time to travel, but you're going to have a lot of company. Normally, the fall season, things slow down a bit in terms of, the destinations aren't so crowded and all of those things. But this year, demand is really booming for all kinds of travel. International travel is a particular hotspot, but cruises, amazingly, cruises are up like 19% over last year. I mean, they're really booming. And so the summer, we saw, yes, okay, people really have happy feet. They want to get moving. And the good news is, okay, so yes, in fact, the destinations may be a little more crowded than you might have had last year, but the good news is that airfares are down from the summer, close to around 30% airfares are down. You can find some really great deals, some good opportunities there. If you're driving, gas prices have been sliding since July. They fluctuate a bit, but they are on the way down. So this is a good thing if you want to hit the road with your car. And in addition to that, we're seeing some pretty good, not only are booking prices coming down, but some destinations, like I mentioned Asia being hot, there's some really significant savings to Tokyo, Shanghai, those kinds of cities. So I think that people don't put off the trip. Go do it. I mean, airfares and all the other hotel rates, so forth, will start ticking up in October, and they'll keep, inching up as we get through the holiday season. But they'll still be lower than travel was last year. And so I think we're seeing some great opportunities for people to really get out and do something. So yes, Allie, I would go plan your trip.
Love to hear that, Carrie. Now, when it comes to saving money, what are the best times for people to travel?
Yeah, there's some really hard and fast rules here. The big recommendation from all the travel pros I talk to is try to travel midweek. Tuesdays and Wednesdays are usually you're going to get the best airfares. In addition to that, it's we all know the nightmare of sitting at the airport with delays. Try to book that first flight of the day. Honestly, the chances of you not having a delay are so much better. So if you can bear getting up at the crack of dawn, go and do that, get that first flight out, you're going to be happier. And the thing I love to do, and I think it's really important, it's super easy today, you can set these airfare trackers on Hopper has it, Kayak, Google Flights has it. When you know where you want to go and roughly the days you want to travel, it'll ping you when the fares go up or down in there, and you'll get a sense of, I ought to nail this down right now. So it's always a good way to help you shop for the best airfare, because there truly are, down from the summer, there are deals out there, and you might as well just be prepared that you're not going to be alone out there.
All right, Carrie Hannon with the advice to take the trip, which I always love. Thank you so much for joining us.
Thanks, Allie.
Well, that's it for Wealth. I'm Alexandra Canal. Thank you so much for watching, and stay tuned for Market Domination with Julie Hyman and Josh Lipton. That's coming up at 3 p.m. Eastern. You won't want to miss it.